In September of 1958, a truck full of envelopes pulled up outside a post office in Fresno, California. Inside those envelopes, 60,000 of them, was something nobody in that city had asked for. A piece of plastic, already active, already usable, attached to a real line of credit worth up to $500, mailed straight to your mailbox, whether you wanted it or not. No application, no interview, no proof you could pay it back. Just, here, spend this. A bank did this. On purpose, knowing that a huge number of these cards would get stolen out of mailboxes, knowing fraud was basically guaranteed, knowing some people would never pay a cent back. And they did it anyway. Within 13 months, 2 million of these cards were circulating through California. That bank lost $20 million in the process, in 1958 money, which today is well over $200 million, gone, before the idea even proved itself. I want to show you why a bank would do something this reckless. And I want to show you what it turned into. Because that one mailing, that one insane bet, is the reason your wallet looks the way it does right now. It's the reason a piece of plastic can talk your brain into spending money you don't have, in a way that feels almost nothing like spending money at all. By the end of this, you're going to understand why Americans currently owe $1.25 trillion on their credit cards, why that number is rising every single quarter, and why the system was never really designed for you to pay it off. This is the story of credit, and it starts a lot earlier than 1958. It starts about 5,000 years ago, in the mud between two rivers, Mesopotamia, modern-day Iraq, roughly 3000 BC. No coins yet, no paper money, nothing you'd recognize as currency, but there was debt. Farmers in Sumer needed grain to plant before harvest. Temples had surplus grain sitting in storage. So a farmer would go to the temple, and a scribe would press a wedge-shaped symbol into wet clay, recording exactly how much grain was borrowed and exactly how much was owed back. Then they'd let the clay dry into a hard, permanent record. This is, functionally, the first credit statement in human history. Except instead of a monthly bill mailed to your house, it was a tablet sealed inside a clay envelope, marked with the borrower's personal seal, so nobody could tamper with it. And here's the part that should stop you. These loans had interest. Historians studying Babylonian math problems from the era of King Hammurabi found something that looks almost exactly like a compound interest calculation. The idea likely came from something very simple and very old. A farmer watches his herd of animals grow over a season. More animals, born from the animals he already had. Someone, somewhere, looked at that and thought, money should probably work the same way. Lend some out and it should come back bigger than it left. That single idea, debt should grow over time, is the seed of every credit card statement you've ever opened. It just took about 5,000 years and one forgotten wallet to turn it into plastic. Let's fast forward, way forward. Rome falls, empires rise and collapse. Debt keeps existing quietly the whole time, mostly informal, mostly personal, a shopkeeper letting a regular customer run a tab, a neighbor lending money to a neighbor. By the late 1800s in America, this gets a little more organized. Some merchants start handing out small metal coins, or fobs, stamped with an account number. Show the coin, get the goods, settle up later. No interest on most of these, just trust, formalized into a piece of metal. Department stores figure this out fast. If you let your best customers buy now and pay at the end of the month, they buy more. They come back more often. Store credit becomes a competitive weapon. But all of this is still tied to one store. Your metal coin from one shop is worthless at the shop next door. Nobody's built a piece of credit that works everywhere yet. That changes because of an embarrassing dinner. New York City, 1949. A businessman named Frank McNamara is out at a restaurant called Major's Cabin Grill, entertaining clients. The bill comes. He reaches for his wallet. It's not there. Left at home. In front of clients. In front of everyone. His wife has to come bail him out, cash in hand, while he sits there mortified. Now, most people have this exact moment and just feel embarrassed for a night and move on. McNamara didn't move on. He got obsessed with a question. What if there was a card, one single card, that worked at any restaurant, no matter which one, and you just settled the bill once a month? By February of 1950, he's back at that same restaurant, this time with a business partner named Ralph Schneider. And this time, instead of cash, he pays with a small cardboard card. They call it Diners Club. Cardboard, not plastic yet. Accepted at 14 restaurants in Manhattan when it launched. Within a year, over 20,000 people had signed up. Diners Club wasn't a bank. It didn't lend you money with interest. It was a middleman. You'd eat, sign, and Diners Club would pay the restaurant, taking a cut, usually 5 to 7%, and then bill you once a month for the total. Pay it in full. No revolving balance, no interest trap, just convenience wrapped in a small paper card. By 1953, it's international. Canada, Mexico, Cuba, the UK. And Diners Club proves something the banking industry couldn't ignore. People will change their spending behavior dramatically if you remove the friction of handing over physical cash. American Express notices. They launched their own version in 1958, the same year actually as our story in Fresno. But Diners Club and Amex were still, in a sense, elite products, aimed at businessmen, travelers, people already trusted enough to get approved. The real explosion, the one that would eventually touch almost every household in America, needed something different. It needed a bank willing to gamble on strangers. Enter Bank of America. By the late 1950s, they're the biggest bank in California, and they've got a research team, kind of an internal think tank, led by a guy named Joseph Williams. Williams has an idea that sounds almost insane when you say it out loud. Instead of waiting for people to apply for credit, what if you just gave it to them? Pre-approved, fully active, mailed directly to their home. No waiting, no forms, no credit check in the way we'd understand one today. His bosses say yes. They pick Fresno as the test city, partly because almost half the households there already banked with Bank of America, and partly, and I love this detail, because they figured if the whole thing blew up in their faces, nobody in the national media would be paying much attention to Fresno. September 18th, 1958, the Fresno drop. 60,000 active Bank America cards land in mailboxes across the city. Overnight, thousands of people who never asked for credit suddenly have it. $500 worth on average, which in today's money is something like $5,000, just arriving. Some people used it responsibly. A lot of people did not. Fraud exploded almost immediately. Cards were stolen straight out of mailboxes before the actual owner even opened their mail. Merchants who'd never processed a credit card before in their lives had no idea how to verify anyone. Delinquency hit 22%, which, in banking terms, is not a rough patch. That's closer to a crisis. $20 million gone. Joseph Williams, the man who built the whole thing, resigned within about a year. And here's what fascinates me about this moment in the story. By almost every normal business standard, the Fresno drop was a disaster. It should have killed the idea entirely. Instead, Bank of America looked at the wreckage and saw something else. Underneath the fraud and the mess, actual real behavior. People liked this. People used it again and again for things they wouldn't have bought with cash sitting in hand. The bank tightened its systems, fixed the screening process, and kept going. By 1966, they started franchising Bank Americard to other banks across the country. A network of card-issuing banks, all speaking the same language, all honoring the same piece of plastic. That network eventually needed a cleaner, unified identity. In 1970, it reorganized into something called National Bank Americard Incorporated. By 1976, it had a new name, Visa. Meanwhile, a rival group of California banks, worried about being left behind, formed their own competing network. That one became MasterCard. So by the mid-1970s, the basic architecture is in place. Two competing networks, dozens of banks issuing cards under each one, millions of Americans carrying plastic in their wallets. But there's still one massive problem standing between this industry and the version of itself you'd recognize today. Interest rate caps. Almost every state in America had usury laws, laws capping how much interest a lender could legally charge. Most were somewhere around 10 to 18%, which sounds reasonable, which honestly is reasonable. But it meant credit card lending, especially to riskier customers, just wasn't that profitable. Banks were extending $500 lines of credit to strangers and could only charge, at most, something like 18% to cover the risk of people never paying it back. The industry needed those caps gone. And in December of 1978, the Supreme Court handed them exactly that, almost by accident. The case was called Marquette National Bank versus First of Omaha Service Corporation. A bank in Nebraska, First of Omaha, was mailing Bank Americards to customers in Minnesota. charging them Nebraska's interest rate, which was higher than what Minnesota law allowed. A Minneapolis bank sued, arguing this violated Minnesota's usury protections for its own residents. The Supreme Court disagreed, unanimously. They ruled that a nationally chartered bank only has to follow the usury laws of the state where it's headquartered, not the states where its customers actually live. Read that again, because it's the hinge the entire modern credit card industry swings on. It meant a bank could set up shop in whichever state had the loosest interest rate laws, and then legally charge that rate to customers in all 50 states. Which meant, almost overnight, states had a new incentive: attract banks, by having no usury cap at all. And one state moved on this faster and more aggressively than any other: South Dakota. February 1980. The state's economy is, in the words of its own governor, dead. Farming's in decline, wages are the lowest in the country, young people are leaving. Citibank, based in New York, is in trouble too, in a completely different way. New York's usury cap has them squeezed. They can't legally charge enough interest to make their credit card division profitable during a period of brutal inflation. So Citibank's lawyers do something bold. They start hunting for a state legislature that's still in session, that has no usury cap, and that would be willing to invite a giant out-of-state bank in. They find South Dakota. Governor Bill Janklow doesn't hesitate. Within the final days of that legislative session, South Dakota passes a law wiping out its own usury cap entirely and inviting out-of-state banks to set up subsidiaries. By June of 1981, Citibank has moved its entire credit card operation to Sioux Falls. Executives are literally buying houses in the suburbs there. The city throws a parade practically. They call it Citibank Day. And now, Citibank, legally headquartered in a state with zero interest rate limit, can mail a card to anyone, anywhere in the country, and charge whatever rate the market will bear. Other states, watching this play out, and watching New York's economy start losing financial jobs to South Dakota, panic. New York eventually caves and suspends its own usury cap too. Delaware follows. Other states follow. Within a few years, the effective interest rate cap on American credit cards goes from something like 18% to basically nothing. This is the moment credit cards stop being a convenient way to avoid carrying cash and start becoming something else entirely. A long-term lending product. One where the bank doesn't actually need you to pay off your balance. In fact, from a pure profit standpoint, the bank would often prefer that you didn't. Which brings us to a number sitting on your statement right now that most people glance at and completely misunderstand: the minimum payment. Here's the psychology behind that little box. The word minimum sounds like a floor, like the responsible baseline. Pay at least this much and you're doing fine. But minimum payments aren't calculated to help you get out of debt. They're calculated to keep you in it for as long as legally possible, while the bank collects interest the entire way. Let's do actual math, because the math is the part that should genuinely disturb you. Say you owe $5,000 on a card charging 22% interest, which, by the way, is close to the national average right now. If you only ever pay the minimum, you're looking at close to 19 years to pay it off. 19 years. And over that time, you'll pay north of $8,000 in interest alone. More than the original debt itself. For a $5,000 balance, you end up handing the bank more money in interest than you ever actually borrowed. Congress eventually noticed how damaging this was. In 2009, after the financial crisis exposed just how predatory some of these practices had become, they passed something called the Card Act. It forced credit card companies to print a warning right on your statement, showing you exactly how long the minimum payment path would take, and exactly how much more you'd need to pay monthly to actually be debt-free in 3 years. That warning box exists on every statement now. Most people scan right past it. Which is, in a strange way, the whole story of credit cards in one sentence. The information is right there, and somehow, it barely changes anyone's behavior. Which raises an uncomfortable question. Why not? Why does a rational person, someone who would never dream of walking into a casino and betting a paycheck, swipe a piece of plastic for something they can't actually afford, almost without thinking about it? Turns out, researchers at MIT wanted to know the exact same thing. In 2001, a professor named Dražen Prelec ran an experiment. He auctioned off tickets to a sold-out Boston Celtics game. Half the bidders were told they'd pay in cash if they won. The other half were told they'd pay with a credit card. Same tickets, same room, same people roughly. The credit card bidders bid, on average, somewhere between 64 and 113% higher than the cash bidders for the exact same tickets. 20 years later, Prelec went further. He put people in an MRI machine and had them shop for real items with real money, some paying cash, some paying card, and watched their brains light up in real time. Cash purchases barely activated anything. Credit card purchases lit up the striatum, the brain's reward center. The same region activated by cocaine, by amphetamines, by essentially any addictive reward loop your brain has ever built. Prelec has a phrase for this that I think about a lot. Cash releases the brakes on spending. But a credit card doesn't just release the brakes, it steps on the gas. Cash makes losing money feel physical. You watch bills leave your hand. There's a small, real, immediate pain to it, and that pain is doing you a favor, quietly keeping your spending in check. A card removes that entirely. There's no moment where money visibly leaves you, just a tap, a beep, a green check mark. The pain of paying gets pushed weeks into the future, disconnected completely from the moment of actually wanting the thing. And once you understand that, a lot of design choices in this industry stop looking accidental. Take rewards points. On the surface, they feel like a gift. 2% back, airline miles, hotel status. It feels like the bank is on your side, rewarding your loyalty. Here's what's actually happening. Every single time you swipe a credit card, the merchant, the store you're buying from, pays a fee to your card's bank. It's called an interchange fee, and depending on the card, it typically runs somewhere between 1.5% and 3.5% of the entire purchase. That fee is where your rewards points come from, almost entirely, which means merchants raise their prices slightly across the board to absorb that cost. Everyone pays those slightly higher prices. The customer using cash, the customer using a basic debit card, the customer who can't get approved for a rewards card at all because their credit isn't good enough. But only the person swiping the premium rewards card gets anything back. Researchers at the National Bureau of Economic Research studied this directly, and the pattern is almost uncomfortably clean. Lower income households and cash-paying households end up subsidizing the rewards that flow disproportionately to higher income, higher credit score cardholders. It's a wealth transfer. Quiet, legal, built directly into the checkout process, moving money from people who can least afford it to people who least need it. The system rewards you for being the kind of person who is already going to be fine. So how does the system decide who's fine in the first place? That comes down to 3 digits, a number between 300 and 850 that follows you through basically every major financial decision of your adult life. Your credit score. Before 1989, there was no single standardized version of this number. Different lenders used different, often subjective methods, which, if we're honest, meant plenty of room for bias. A loan officer's gut feeling about whether you seemed trustworthy could shape your entire financial future. In 1989, a company called Fair, Isaac & Company, now known simply as FICO, partnered with the credit bureaus to build one universal formula. Feed in someone's payment history, their debts, the age of their credit accounts, and out comes a single number. The pitch was fairness. Replace human bias with cold, consistent math. And in a lot of ways, it worked exactly as intended, giving millions of people access to credit who might have been unfairly denied it before, based purely on a stranger's assumptions about them. But it also created something new, a permanent, quantified record of your financial trustworthiness, one that follows you into apartment applications, job offers, even insurance rates in some states. Miss a few payments in your 20s, and that shadow can follow you for years. And speaking of who even got access to this system in the first place, there's a part of this story that gets left out constantly, and it shouldn't be. For most of the credit card's early history, if you were a woman, particularly a single or divorced woman, you likely couldn't get one on your own. Not because your income wasn't good enough, not because your credit history was bad, because you were a woman. Banks routinely required a husband or a father or some male relative to co-sign, regardless of whether the woman had a stable job, regardless of whether she earned more than the man being asked to co-sign for her. And if a married woman did somehow get a card, it usually listed her as Mrs., followed by her husband's name. Her payment history built his credit, not hers. If he died, or if she got divorced, she could find herself starting completely from zero, with no credit history of her own, despite years of responsible payments. This wasn't some obscure loophole. This was standard practice at nearly every major bank in the country, well into the 1970s. It took a young congressional aide named Emily Card, who had personally hit this wall while working full-time, to help push the issue in front of lawmakers. In October of 1974, Congress passed the Equal Credit Opportunity Act, finally making it illegal to deny someone credit based on their sex or marital status. 1974. Sit with that for a second. Within living memory, an adult woman with a steady paycheck could be turned away from something as basic as a credit card, purely because of her gender. The plastic in your wallet has a genuinely ugly history buried in its early decades. It's easy to forget that when you're just tapping to pay for coffee. Okay, let's zoom back out and bring this story all the way to now. Right now, in 2026, Americans collectively owe $1.25 trillion in credit card debt. That's not a typo, and it's not hyperbole. It's the actual current total, tracked by the Federal Reserve Bank of New York. And the number that should really concern you isn't even the total balance. It's what's happening underneath it. Delinquency, meaning balances at least 90 days past due, just hit 13%. That's the highest level in 15 years. The last time it was this bad, we were climbing out of the 2008 financial crisis. Average interest rates right now are sitting above 21%. For new card offers specifically, we're looking at closer to 24%. Both are the highest sustained rates the Federal Reserve has ever recorded tracking this data. And the group getting hit hardest isn't who you might assume. It's not reckless 20-somethings buying things they don't need. Economists studying this data point out something more troubling. It's not primarily new borrowers falling behind. It's people who were already struggling, sinking further, often because credit cards have quietly become how they pay for groceries, for gas, for rent, for the ordinary cost of simply staying afloat, not for luxury. Researchers have started calling this survival debt. Debt that isn't funding a vacation or a new TV. Debt that's funding basic survival in an economy where wages haven't kept pace with the cost of living. Borrowers under 30 have been hit especially hard. Delinquency in that group has more than doubled in just a few years, which maybe explains the newest chapter in this entire story. Buy now, pay later, Klarna, Affirm, Afterpay. Split any purchase into 4 small payments, often with no interest at all, right at checkout, no credit card required. It's being marketed and genuinely felt by a lot of users as the anti-credit card. Simple, transparent, no hidden interest rate trap. But look at who's actually using it, and the pattern feels familiar. Nearly half of Gen Z consumers say they prefer it to credit cards. Research shows these users often carry multiple overlapping buy now, pay later loans from multiple different apps all at once, coming due on different days in different weeks. It's the same core mechanism that built the entire credit card industry back in 1958. Remove the immediate physical pain of paying. Let people buy now and think about the consequences later. We've just rebuilt it. Smaller payments, friendlier apps, same underlying psychology. So where does that leave us? I keep coming back to that image from 1958. 60,000 envelopes mailed out to strangers, containing something that could genuinely help someone through an emergency, or could just as easily bury them for a decade. The wild thing is, credit itself isn't the villain in this story. It never was. Credit, at its absolute core, going all the way back to those clay tablets in Sumer, is just trust, given a physical form. It let a farmer plant a field he couldn't otherwise afford to plant. It let a small business open its doors before its first sale ever came in. Used well, it's one of the most powerful tools ever invented for letting ordinary people build something bigger than what they could pay for in cash on that exact day. But somewhere between a Sumerian temple and a Fresno mailbox, something shifted. The product stopped being purely about giving people access to money they didn't have yet. It became, in part, a very carefully engineered system for making sure a certain percentage of us never quite finish paying it back. Rewards points funded by fees hidden inside your own grocery bill. Minimum payments engineered to look responsible while quietly stretching debt out for decades. A brain, your brain, being gently nudged, purchase by purchase, tap by tap, to feel less and less friction every single time you spend. 5,000 years ago, debt was etched into wet clay, meant to last, meant to be something you couldn't quietly forget about. Today, it's just a number on a screen, updating in real time, disappearing the second you close the app. Maybe that's the actual story here. Not that credit is good or that credit is bad. but that we built a system that made forgetting easier than ever. And the bill, it turns out, was never actually going anywhere.